Alrighty. So in today's video, I am going to be sharing with you a simple 7-step credit spread trading plan from entry to exit. So if you're new to trading options, especially if you're new to trading credit spread, then you can use this 7-step trading plan that I have for you. Now, this is not the end all and be all, but it's definitely a very great way for you to get started in trading credit spreads. So step number 1 is to build your watch list of index ETFs and individual stocks, right? If you like only index ETFs, you can just build, a watch list out of index ETFs, or if you only prefer individual stocks, then you can do that as well. But if you've been watching my channel for some time now, then you know that my preference is more towards index ETFs, mainly because index ETFs are not as volatile as individual stocks. So here is some statistics and data by the Tasty Trade team as well. As you can see, they've already done a study on the movement of ETFs compared to stocks, right? So as you can see below, this is the standard deviation moves. So basically you can see that the ETFs tend to stay in a narrower range compared to the stocks, right? So this is ETFs. Whereas for the stocks, they actually have a much wider range. Now, when we are trading the credit spreads, ideally, we do not want the market to move that much, right? Especially if it stays somewhere in the middle. We want it to stay in the expected move or move in the opposite direction, right? So if you got your direction right, then of course, if the market moves in the opposite direction of your spread, then you're going to start to make a lot pretty quickly. That can happen in stocks, right? But if you're wrong, then you can really just blow through your spread as well. So that is why I prefer index ETFs. It's much more controlled, even though if the market moves against you, it does not move as much as compared to individual stocks. Now, step number 2 is to go through the chart of each of the underlying on your watch list to identify oversold or overbought conditions. Now, you can identify this oversold or overbought conditions by using indicators. So it will either be the stochastic oscillator or the RSI. So if you're interested in putting on the stochastic oscillator, I actually already have a video which I created to share with you, what are the settings that I put on when I put on the stochastic oscillator, right? So you can go and watch that video. I'll put the link at the top right hand corner of this video. So basically what we're trying to look out for is this oversold or overbought. So as you can see down here, this is oversold, which also suggests that the market, right, has a lesser downside than it has to the upside. Now, that is not to say that the market, once it's oversold, it won't continue to be oversold. Now, of course, there's always a chance, right? But this is just a probability game, right? If you see that the indicator is oversold, it just means, chances are that the move to the downside, there's lesser chance for it to continue moving down compared to moving up. So same thing as well. Down here, you can see that once it's oversold, we're looking for this. And on the other side, we're looking for overbought, right? So basically, when it's oversold, we're looking to put on put spreads. And then when it's overbought, we're looking to put on our call credit spread. Now, step number 3, if it is oversold, you want to identify support levels. And if it's overbought, you want to identify resistance levels. So ideally, we want to place our credit spread beyond the support and resistance levels. And this is very important if you're just starting out, because this will give you a much higher chance of success, because as we already know, support and resistance levels are places where the market can turn, right? So especially if you couple that with, when the indicator is either overbought or oversold, you have a pretty good chance of the market or the trade actually working out in your direction. So for example, as you can see down here, there is a support somewhere around here because prices have previously bounced here and then gone back up. Right? So we know that this could be a very possible support area, as well as down here as well. You see the price bounced down here and then the market went up. So these are lines that we can draw. So what we're really looking for is to place our credit spread below our support area if it's oversold. All right, so this is the put spread, -1, +1. And on the other side, if it's overbought, so for overbought, you want to draw a resistance level. So as you can see, the prices have touched somewhere around here. And then now it's at the same point again. So at this point of time, you can see also the stochastics is showing that it's overbought. So this is where we want to look into selling our call credit spread. So ideally, we want our call credit spread to be above where the resistance is, because hopefully, right, if this resistance actually holds, then the market can actually come back down. And that's where you're going to be able to make your profits on your credit spread. So step number 4 is to identify your DTE, which is days to expiration, basically how many days left for your options to expire, and also the short leg strike price. So basically the lower the delta, the more conservative, the higher the delta, the more aggressive. And I'll get into this in the next slide, but for now, let's talk about the DTE. So whenever I share any strategy with anyone, people have always asked me, Davis, can I use the strategy, on the 7 DTE, the weekly DTE, the 14 DTE, or even the 0 DTE? And the answer I give them is, of course, yes. There's no stopping you for putting whatever you want to put on, right? You can put 0 DTE, 2 DTE, is all up to you. But whether we have an edge using that time frame, the DTE, is another question. So for this, we want to lean on research. And this is a research piece that I've shared, quite a number of times. Basically, this research piece is measuring the expected move compared to the realized move. So as we know, when we are trading short options, our edge lies in the fact that the expected move is greater than the realized move, right? So that is why we win more often than we actually should be, as depicted by the theoretical win rate, right? So in this case, you will notice that if you were to go with the 7 days option, right, the 7 DTE, you notice that the expected move is actually not bigger than the realized move. For the 14 days, it's not bigger as well. 21 days is not bigger. 30 days is not bigger than a realized move as well. Only when it's from 45 days, it's bigger, right? 45 days, it's bigger than the realized move. 60 days, expected bigger than realized, yes. And 90 days, expected bigger than realized. So basically, anything under 45 days, these are the times whereby we do not necessarily have a statistical edge, right? And this is a pretty significant data set. As you can see, this is done since 1993. So there's quite a little bit of a data that has gone into this testing, this experiment. So whenever we're trading, this kind of strategies like credit spreads or iron condor, put ratio spreads, basically we want the market to stay in the expected range as long as possible, right? As often as possible. That is why we always want to look to the data whereby, the expected move is bigger than the realized move. But if the expected move is not bigger than the realized move, it means now we don't really have an edge down there. So should you go for the 7 days or even the 0 DTE, credit spread? Well, we've already seen the data down here. So it's really up to you to decide, right? If you are getting good results for it, go ahead. But for me personally, I prefer the 45 to around the 65 days DTE. For me, that's the ideal one. Anything longer than that, there won't be really that much, kind of a theta decay, because it's going to be very slow, right? So roughly anywhere from 45 to 65 is kind of the sweet spot for me, okay? Next, we want to identify where your short leg strike price is going to be, right? Because now we already identified the DTE, we already identified, all right, is it going to be a put spread or a call spread? So now we know that, okay, we have seen that the stochastics is oversold, and then now we have identified where our support area are, right? So for this, we want to place our short strike, right? We first focus on the short strike. We want to place our short strike below where the support area is. So there are different places where you can put, right? If you want to be a little bit more aggressive, you go for the higher delta, then you can put it closer to where the current market price is for your short strike. So this is where your current delta is. Basically, it will be slightly higher. So when it's higher, basically you get slightly more premium and slightly more favorable risk to reward ratio compared to if you were to go for the lower delta. So the lower delta is basically, your short strike is slightly further away from where the current market is compared to the higher delta. So again, there's no one that is better than the other. It really comes down to your outlook, and they are just trade-offs, right? So if you're slightly more bullish, you can go with this, right? Because you get more premium upfront. But if you're more conservative, then you want to go for this one, right? You put it slightly further away from where the current market price is, and then there's a lesser chance for the market to actually breach this short strike compared to this one with the higher delta. Now, what about for the call spread? So for the call credit spread, same thing as well, right? It's just the opposite. So if you want to go for slightly more aggressive take, that means you are very confident, right, that the market is going to drop after, it hits the resistance point, then you can go for the higher delta short strike for the call spread, right? You could choose one that is slightly closer to the market. If you're slightly more conservative, you can go for the one that is slightly higher. Okay, next step. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Now that we have already identified where our short strike is going to be, next is where we want to define our spread with, right? So this is where we want to take into account our maximum risk that we have allocated for the trade. So this is very important. So you want to practice very good capital allocation so that you really do not mess up, right? Especially when the market goes against you, because there are times the market will go against you, you will lose money. Okay, so you just have to be prepared for that. This is just part and parcel of trading. So for this, you want to identify what your max risk is, and then you start building your spread from there. So let's say, for example, your max risk is $500, which means to say you cannot lose more than $500 for any particular trade. Okay, so in this case, what you want to do first is you want to start off with a $5 width, right? Because that is basically the max loss of your credit spread, right? Your max loss for your credit spread is basically your width minus the premium. So in this case, if we start off with a $5 width, right, just to get you started to design and construct your credit spread, because you have a $500 risk, you put $5 width, and then you see what kind of premium you get. Right, so in this case, you notice that your premium is $1.25. So you know that your max risk on this trade is actually $3.75, which is $375 per contract, which also means to say, hey, you actually still have, some room to add more risk to this trade, right? If you want to fulfill this capital allocation. So in this case, some people will actually just double up their spread. They will actually just times 2, and then now they will have a risk of roughly $750. Is that correct? Yeah, $750. So it's slightly above $500. And I don't really like this approach, and the reason is because it's going to be much more riskier compared to if you were to widen your width, right? So the next approach will be to widen your width. And I actually already explained this in a previous video, where what are the top 3 deadliest mistakes for credit spread. So this is actually one of them, where people actually choose to double up their spread. If they see that their risk is, let's say, $1,000, then if they see that per trade they actually risk only $375, they're going to just have a multiple of this, maybe it's times 3 contracts of this. But the better approach would actually be to widen your width. Why? Because your risk per trade actually does not change, right? Your risk per trade is going to be the same. The difference is that for the one which you have multiple credit spreads, you'll find out that you're actually going to hit your loss much faster, because this long put strike down here is much closer to where the market price is compared to where it is if you were to widen the width. So that is why the approach would be safer, or rather it's less riskier if you were to widen the width. So by going with the $5 wide width, you notice that your risk is only $375. So what you can do is you can just widen it a little bit now. So you go with the $6 width right now, and then now you see what's the premium that you can get. So you calculate your max risk is $450 per contract. So now this is very close to $500, and you can definitely go with this spread right now. Now, what if your max risk is $1,000? So in this case, you can start off with a $10 wide spread, and then you work your way from there, right? So $10 wide spread, and then you see your premium is $2.50. So that means your max risk will be $750. So in this case, what you want to do is widen it again and to see, what's your max risk. So if you widen this now to $12 width, you find that your max risk will now be $880, which means to say there is still some room for you to widen your width. So you try and widen again. Now you go for the $13 wide width, and now you see that it's $950 per contract, which means to say now it's pretty close to where your max risk per trade is, and that means you can go for one credit spread, one put spread, instead of going for $5 wide and then you times multiples of that, right? So this is for the put spread. For the credit spread, it's just the opposite, so I won't go into that. Step number 6. So now that you've already gotten your credit spread with, where your strikes are, it's time for you to actually enter the trade, right? So you want to place this using a limit order, and if it's not filled, you can either wait or adjust till you get filled. So how do you know whether you have a good chance of getting filled? So the way I like to put it is basically I like to take a look at this expected price first, right? So this expected price is shown on your platform on TD Ameritrade. Tasty Trade have as well. So you want to take a look at the platform that you're using to see whether they actually give you an indication of where you're likely to get filled, right? So for this, you can see that the mid is 1.97, which means to say that this is the mid price. It's not the guaranteed fill price. The guaranteed fill price is down here. So when we are selling credit spreads, we want to get as much credit as possible. So usually I like to start slightly higher than where the mid price is. Try to test a little bit of my luck to see whether I can get filled at a higher price, because sometimes you do actually get filled when it's a little bit higher, or the market could just come to you. So generally that is why I place it around the mid price. Now, so in this case, let's say we start off at $1.99. So this is just 2 cents above the mid price. So what I'll do is I'll put in the order ticket, I'll confirm and hit send. And if it's not filled, there are two things you can do, right? If it's not filled, you could either wait until you get filled, or if you do want to get filled, right, if you're afraid that the market is going to run away, then this is where you want to do what is called price discovery, right? Price discovery is basically just to lower your credit price until you get filled. So maybe the next one you can change to $1.98, and see whether you get filled. If 198 cents you're not filled, we change to $1.97. If it's still not filled, you move down $1.96. If it's still not filled, you go down lower. So basically you get the point, right? You just inch down bit by bit. Now, what if you're on an underlying where this spread is actually pretty big, right? This gap down here is pretty big. Maybe on the left hand side, you will see 1.5 as the natural. This is where you're guaranteed to get filled. And maybe on the right hand side is $2. So if you see this, you notice that the spread is pretty wide. So in this case, you may not necessarily want to inch down by 1 cent, because if you're going to do that, you may have to do a really long time. From $2, you want to inch it all the way down to 150. So in this case, maybe you can do 2 cents, 3 cents, or even 5 cents interval, right? Every 5 cents. Maybe start with $2, it doesn't get filled, drop to 195, then you go to 190, so on and so forth. All right. So this is how I will actually enter into my trades. Now, next, you want to plan your exit scenarios, right? So once you already got the trade in, you want to plan how you're going to exit. So there are generally 2 ways you can do that, right? And an additional third way. So the first way is basically a fixed take profit, right? A fixed take profit generally is like maybe 50% of the max premium that you can get. So let's say, for example, if the max premium is $2, you may have a take profit at around $1. So as you can see down here, this is a study done by the Tasty Trade team again. Basically, they compared if you were to hold your credit spread to expiration versus, you were to take off at a fixed percentage. So in this case, I believe they did it at 50%. You can see that the win rate is much higher if you had a take profit at 50%, right? You can see that your return is also much higher. You can see your daily P&L is higher than if you were to hold to expiration. Now, the other way is to exit your trade early, which in this sense is basically to exit at 21 DTE. So as you can see, if you were to exit at 21 DTE, your average loss is much lesser, although you have a slightly lower win rate, but your return is actually still higher than if you were to hold all the way to expiration. So when you're trading credit spreads, ideally, you do not want to hold to expiration, because if you hold to expiration, you also have the risk of early assignment, right? So it would be better if you either chose to exit, at a fixed take profit point, or to exit early at 21 DTE. Now, you might be asking which is better, right? Which one should you choose? So there really isn't one that is better. It's just that there are pros and cons. So you can see that if you were to take profit at 50%, right, you will have a high win rate, but you have no loss control, right? Your loss will be pretty similar to if you hold to expiration. And for 21 DTE, you will have lower volatility, which means to say that you actually have, lesser average losses, but your P&L is more random. So as you can see down here as well, for the max drawdown, you can see for the holding to expiration, you notice that it's pretty same as if you're a 50% winner, right? So this is talking about, the kind of losses that you could see on your trades. So if you're one that, you don't like to see that much losses, you like a very controlled volatility in your P&L, then you want to go for exiting at 21 DTE. Now, the alternative will be just to have a combination of both, right? You can either go for 50% winner or 21 DTE, whichever comes first, right? So that means if it hits your 50% take profit, you're out of the trade. And if at 21 DTE, it doesn't hit your 50% take profit, you just get out of the trade. So this way, you kind of have like the best of both worlds. So again, there is a study done where they, show the results of all the 3 different management styles, right? Exit at 21 DTE, take profit at 50%, and the combination of both. Now, this is on the 16 delta puts, because I don't think there is a study on the put spread, right? right? At least I couldn't find one. So for this, it's pretty similar, right? So you can see that with the combo, you can see that it's slightly below the earlier and the winner, right? But at the same time, you notice that it's also pretty controlled, your P&L, right? At times, right, you'll notice that your P&L is actually above winners if you were to take profit at 50%, and pretty much on par with managing earlier. So this really comes down to you. So either one of this is good as long as you do not hold to expiration. Now you might be asking, what about stop losses, Davis? If I implement a stop loss, will it improve my performance if I were to add this, with the take profit and the exit at 21 DTE? So one thing you have to understand about the credit spread is that the credit spread already has an inbuilt stop loss in place. That is why you put on the credit spread in the first place. It is a spread, it is not a naked position, right? If you go on a naked position and you're thinking of putting a stop loss, I can understand that kind of thinking. But when it comes to a credit spread, there really is no point because it's redundant. It's like having a stop loss on top of another stop loss, right? So if you already have a credit spread, then this is where you already have your stop loss. No need to put another stop loss. Now, just in case you're wondering, what happens if you actually put a stop loss? Then the Tasty Trade team actually has already done a study on this, because apparently a lot of people have been asking about this as well. And you can see that the results, the performance is actually worse than if you were to hold it to expiration. Can you see that? So in this case, you actually might as well just hold to expiration rather than to manage your loss. That means to have a fixed cutoff point. So as you can see in this case, it doesn't really work so well when it comes to trading options, especially when it comes to trading spreads, because spreads already have an inbuilt stop loss in place. So when it comes to trading credit spreads, I don't want you to focus on having a stop loss, because there's no point, but rather focus on your max risk per trade, what you're comfortable with as the max loss for the particular spread. Then you want to exit based on either getting out at 50% of the profit or exiting at 21 DTE, or a combination of both. So guys, this is the 7-step credit spread trading plan. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.